There is a type of financial risk nobody warns you about because it looks exactly like caution. It does not show up in market volatility. It does not show up in the news. It shows up 10 years later when you look at your account balance and realize the number went up, but the life it can buy has been shrinking. And the person this risk hits hardest is not the reckless spender, not the reckless gambler. It is the person who did everything right. In 1970, a man named Harry Browne published a book. He was not an economics professor, not a banker, not someone with inside information. He was an ordinary American writer who sat down, looked at the mechanism of the monetary system, and reached a conclusion that most financial experts at the time called delusional. His conclusion: the dollar would suffer a serious devaluation before the end of 1971. Gold, then fixed at $35 an ounce by government policy, would rise sharply, and the people holding their wealth in conventional financial instruments, bonds, savings accounts, whole life insurance, would lose most of their purchasing power without ever realizing it was happening. He was ridiculed. In August 1971, Nixon appeared on television and used the word temporarily to end the system that had anchored the dollar to gold since World War II. Browne's follow-up book, published in 1974, sat at #1 on the New York Times bestseller list for 39 consecutive weeks. Anyone who followed his 1970 recommendation walked away with approximately 24 times their money by January 1980. Browne was not richer than other people, not smarter in the conventional sense. He simply understood a mechanism that others refused to see because seeing it required doubting institutions they had spent their entire lives trusting. That mechanism has a name, and it is running right now. I call it the compliance trap. The compliance trap is not a scam you fall into, not a mistake you make. It is the natural result of following every instruction the formal financial system gives you. Save consistently, diversify responsibly, hold safe assets, while that same system runs a mechanism against you that is silent, invisible, and completely legal. Browne saw it in 1970. Most people only saw it a decade later, when the damage was already done. To understand why he was right, and why that same mechanism is not history but is running today, you need to see the true scale of what actually happened. Because this is not a story about American inflation. The United Kingdom, a founding member of the IMF, an institution that normally dealt with developing nations, was forced to request a bailout of $3.9 billion, the largest in IMF history at that time. Italy ran out of physical coins. Banks issued emergency certificates called mini assignee in denominations of 50 to 350 lira because there was not enough physical currency to conduct ordinary daily transactions. The French franc failed 4 separate attempts to maintain a stable exchange rate. Japan's domestic inflation reached 23 to 25%, among the worst of any developed nation. Even Germany, which held better than everyone else, still saw inflation peak at 7%. The Swiss franc, the strongest currency on earth, appreciated 157% against the dollar over that decade. That sounds like a meaningful hedge. Turns out it was roughly 1/15 of what gold returned over the same period. Every paper door was locked simultaneously. There was no safe foreign currency. Every exit through national currency was already closed. 3 men saw this coming before it happened. All 3 were dismissed as eccentrics. All 3 were correct, with a documented return of approximately 24 times in 8.5 years. But here's the detail that most people skip over completely when they tell this story, the detail that turns it from a history lesson into something considerably more unsettling. In the first 4 years of this crisis, the most effective way for ordinary Americans to protect themselves was a federal crime. The government made that deliberate. And by the time the restriction was lifted, the price had already more than tripled. The window was closed. The compliance trap does not only run through markets, sometimes it runs through law. Physical gold, not paper claims on gold, not gold funds, physical metal. Gold closed 1971 at $44.60 per ounce. By the end of 1973, it had crossed $100 and never returned below it. In 1979 alone, it moved from $233 to $300 in July, $400 in October, $500 in November, and $600 on New Year's Day 1980. On January 21st, 1980, the London PM fix recorded $850 per ounce. That is approximately 19 times the 1971 price in 8.5 years. Real estate with fixed-rate debt. The mechanism here is counterintuitive and worth understanding precisely. Inflation erodes the real value of fixed debt. A homeowner who borrowed $100,000 at a fixed rate in 1971 was effectively repaying that loan with dollars worth roughly half as much by 1980. Inflation was destroying the debt on their behalf, while the underlying property held its real value. The debt became the hedge. Commodities broadly, oil, agriculture, raw materials, anything with physical scarcity that could not be printed. Art markets documented average annual appreciation of 33.2% from 1973 to 1981, according to period records. And what was destroyed? Savings accounts capped by Regulation Q at 5.25%, while inflation ran 7 to 14%. A person who deposited $100,000 in 1971 accumulated roughly $158,000 in nominal terms by 1980. That $158,000 bought approximately $77,000 worth of goods in 1971 purchasing power. They appeared to earn interest. They lost nearly a quarter of their real wealth in the process. Long-term treasury bonds delivered negative 3.43% real annual returns throughout the decade, the worst performance in a 40-year bond bear market. Whole life insurance, savings bonds, fixed pensions denominated in dollars, exactly what the financial establishment called safe. Exactly what quietly destroyed purchasing power over 10 years. Now, I want to name this more precisely because the name matters. Names help you recognize something when it is happening to you. I call it the invisible transfer. The invisible transfer is not a crash, not a crisis you can see and react to. It is a slow, structural, decades-long movement of purchasing power from people who hold paper claims on institutions toward the institutions managing the currency. It is completely legal, it requires no announcement, and it works most effectively on the people who trust the system most. Browne did not predict a crash. The millions of Americans who held savings bonds and whole life policies and fixed pensions did not lose money through a single dramatic event. They lost it through 10 years of ordinary mornings when account balances rose slowly while prices rose faster, and that gap, day by day, quietly transferred purchasing power from their accounts to the system issuing the currency. The question is not whether this happened in the past. The question is what its rate is today. And to answer that, you need to understand why conventional diversification does not solve this problem, no matter how perfectly you execute it. Most people respond to financial risk by diversifying horizontally. Some stocks, some bonds, some real estate, maybe some commodities, spread it out to reduce exposure. But here's the structural problem that horizontal diversification does not solve. The assets still sit in separate categories. They grow or shrink independently. And when income stops, when you retire, lose a job, or need capital, the plan shifts from accumulation to drawdown, selling assets to fund life. And every sale permanently terminates the compounding on that capital. The 60/40 portfolio has averaged approximately 6.9% annually over the last 10 years. The more broadly diversified all-weather approach has averaged closer to 5.6% over the same period. Those numbers sound reasonable until you price them against the real rate of cost of living growth. At that point, they are not conservative returns, they are a slow, guaranteed loss. Being so safe that you are guaranteed to fall behind is not safety. That is the compliance trap with better marketing. And after taxes, roughly 1/3 of nominal gains in most brackets, and after fees which compound against you silently across decades, the real return on most conventional investments lands somewhere between 50 and 60% of the number on paper. Not what you earn, what you keep. The invisible transfer is running inside your portfolio right now without requiring any monetary crisis at all. So if the default structure is a slow, guaranteed loss, what does the alternative structure actually look like? This is not a question about which investment product to buy, not about which stock or which fund. This is a question about architecture, how assets are connected to each other inside a system, and the difference between two architectures after 20 years is not measured in percentage points. It is measured in multiples. I call this the architecture layer, and it starts with a question most people have never been asked about their own finances. The question is not, where should I invest? The question is, how many jobs is my money doing at the same time? The middle class builds wealth horizontally. Each asset does one job, grow or generate income, and sits in its category. When you need money, you sell from that category. The wealthy build wealth vertically. Each asset does multiple jobs simultaneously. It grows, it builds equity, and it functions as collateral to access liquidity without selling. When they need money, they borrow against assets rather than selling them. The asset continues compounding at full value. The loan is not a taxable event. The rule of 72 makes clear why this matters at a scale most people have never calculated. Divide 72 by your annual growth rate and you get the number of years to double. At 6.9%, money doubles roughly every 10 years. At 20%, every 3.5 years. Start with $1 million at 20%. 1 million, 2 million, 4 million, 8 million, 16 million, 32 million, 64 million, 128 million. The last doubling creates more wealth than every previous doubling combined. This is why the wealthy do not sell assets, not because they do not need money, because they understand that every sale permanently surrenders the largest compoundings, the ones that come later. When you sell at 8 million and feel successful, you just surrendered the next 120 million. And right now you're probably thinking, this sounds like advice for people who already have millions. It is not. The architecture question applies at every level because the habit of connecting assets to your life through structure rather than through selling is what determines which side of the compounding curve you are on 20 years from now. The dollar amount at the start matters far less than the structure you build around it. The architecture layer is not about products. It is about how you connect assets to your life, not through selling, but through structure. Now you have the mechanism, you have the history, you have the alternative structure. There is one question left. And this is the question I cannot answer for you, but I can give you the data to answer it yourself. The global central banks, the very institutions managing the monetary system, purchased more than 1,000 tons of gold each year in 2022, 2023, and 2024. 3 consecutive record years, more than double the prior decade's average. This is not speculation. This is documented purchasing behavior recorded publicly by the World Gold Council. The institutions managing the monetary system are hedging against the potential failure of that same system. That is not a fringe position. It is their revealed behavior. United States debt currently sits at approximately 121% of GDP. Annual interest payments have recently exceeded defense spending. The open question is this: could any modern central banker do what Paul Volcker did in 1979? Raise rates past 20%, accept 2 recessions and nearly 11% unemployment, hold the line until inflationary psychology broke, given today's debt load? That question does not have a clean answer. The fact that it is a live question is itself a data point. Harry Browne did not have information you do not have. He was not sitting in the Fed's meeting rooms, had no inside sources. He simply sat down and asked a question most people do not ask. Not because it is difficult, but because the answer requires doubting institutions they have spent their entire lives trusting. The question was this: what is the mechanism actually operating here, and who does it serve? While millions of Americans were holding bonds, paying insurance premiums, depositing savings, and trusting they were building security, Browne was asking that question. And the answer led him to a conclusion the market then confirmed at 24 times. The financial architecture of your life is either designed by you or assigned to you by default by the system. That default has a name. Browne named it in 1970. You have just knew it today.